Welcome back to Smart Stock Sam, the channel where we cut through the noise, ignore the headlines, and find the setups that actually move the needle. And today, we are doing a full anatomical breakdown of one of the most explosive moves in the healthcare space this year. We're talking about Hims and Hers Health, ticker HIMS, a company that just delivered a nearly 50% rally in 5 trading days while the majority of the market was still trying to figure out what happened. Now, you clicked on this video because you want to know one thing: is the bull run finished, or are we looking at the opening act of something much bigger? By the end of this video, you will have clear price targets for next week, a deep understanding of the structural forces driving this move, and the one hidden metric that changes the entire valuation conversation. Here's your roadmap. We cover the regulatory spark that ignited the fuse, the business model transformation that neutralized the bear case, a hidden subscriber metric Wall Street is only just starting to price in, the short squeeze mechanics still coiling under the surface, the technical setup for the week of April 20th, and the ultimate July catalyst that could make everything we saw last week look like a warm-up act. Stay with me because this one has layers. Before we get into the fundamentals, let's establish the price action that brought us here, because context matters. Between April 13th and April 17th, Hims did not drift higher. It absolutely detonated. The stock climbed from a structural floor of $19 all the way to a Friday close of $28.82, on volume that had traders scrambling to understand what was happening in real time. If you were looking at a standard technical screen at the end of last week, the RSI was flashing overbought, and most people closed their browser assuming they had missed the trade. That is a mistake. This was not a meme-fueled, retail-driven sugar high. This was a fundamental re-rating driven by what I call the catalyst triad, a massive regulatory policy shift, a critical model transition, and a TAM expansion into a market most sell-side analysts were not even modeling yet. Any one of these landing in isolation would move the stock. All three hitting simultaneously in the same week? That is how you manufacture a $28.82 breakout that catches the entire short-selling community completely off guard. Let's go through each pillar one by one. The first and most important pillar, the one that actually lit the fuse, came directly from Washington, and it involves some very high-profile names. HHS Secretary Robert F. Kennedy Jr. issued a directive pushing the FDA to formally review their stance on peptides. Specifically, 12 peptides are being evaluated for removal from the high-risk category list, and 7 of those are being targeted for the 503A bulks list, with a deadline of this coming July. Now, here is why this is absolutely critical for Hims specifically. The company spent all of 2025 quietly and deliberately building out a massive, compounding infrastructure facility in California. Most investors completely overlooked that capital deployment at the time. That facility was not built for the present business. It was built for exactly this regulatory scenario. The moment those peptide classifications ease, that facility instantly transforms into a high-margin longevity and metabolic treatment engine with no incremental build-out required. The infrastructure is already in place, ready to capture a wave of demand in the peptide space. And here is the question I want you to sit with. If all 12 peptides get cleared instead of just 7, or if the timeline accelerates beyond July, what does that do to the revenue model? Keep that question in the back of your mind, because we are coming back to it. The second pillar directly addressed what had been the single loudest item in the bear case against Hims for the better part of a year. The argument was simple and seemingly airtight. The FDA would eventually clamp down on compounded GLP-1 products. And when that happened, Hims would be left without its core weight loss revenue driver. That thesis did not weaken last week. It got surgically dismantled. Through a landmark strategic partnership with Novo Nordisk, Hims is pivoting away from compounded semaglutide and toward branded distribution of Wegovy and Ozempic. The scale of what they have already built here is staggering. They are currently pacing at over 100,000 prescriptions per month through this channel. By moving to branded products, they do not just follow the regulatory landscape, they get entirely in front of it. Wall Street can now model a reliable, long-term, FDA-compliant supply chain directly into their earnings forecasts. The regulatory overhang that kept institutional money on the sidelines just evaporated overnight. You cannot overstate how significant this risk removal is for the investment thesis. The third catalyst arrived on April 17th, and based on the commentary I have seen online, a large portion of the investing community is still completely asleep on it. The FDA signaled a meaningful new openness to expanding therapy protocols for idiopathic hypogonadism, which, stripped of the medical jargon, is a massive regulatory green light for the testosterone therapy and hormone optimization market. Here is the critical detail. Hims already built its infrastructure for this vertical in late 2025. They are not scrambling to respond to this opportunity. They have an existing platform sitting ready to activate against a newly unlocked addressable market. They are evolving from what the market valued as a direct-to-consumer prescription app into a full-scale hormone and metabolic health platform. Those two businesses carry very different revenue multiples, and the market is only beginning to reprice that gap. What does the ceiling look like for a company that controls the distribution rails across weight loss, hormone optimization, and longevity peptides simultaneously? Nobody has a clean answer to that yet. Now, here is the hidden metric I promised you at the top. The one number that fundamentally changes how you think about the valuation of everything we just discussed. The historical bear thesis on Hims was anchored to the idea that their subscribers were essentially one-and-done customers. Sign up, fill one prescription, cancel. Under that model, the historical lifetime value per subscriber sat at roughly $835. That was the anchor bears used to argue the stock was stretched on any reasonable multiple. That anchor is now gone. Through their pivot to multi-month subscription plans, Hims has successfully reduced churn by a staggering 40 to 60%. When you apply that churn reduction to the lifetime value calculation, you mechanically arrive at over $2,000 per subscriber. Think about what that means structurally. Doubling your lifetime value while simultaneously expanding your total addressable market through peptides and hormone therapy does not just improve the earnings outlook in a linear way, it justifies a fundamentally higher revenue multiple than the stock carries today. This is the number that growth-focused institutions are quietly rebuilding their models around right now, and the broader market has not fully caught up yet. Let's now address the one data point that gave some analysts pause, because I want to be completely transparent with you. There is a $65 million revenue headwind visible in the Q1 data, and if you read some of the cautious notes circulating last week, it sounds alarming without context. Here is what actually happened. That headwind was purely mechanical, driven entirely by shipment timing friction during the transition from compounded to branded products. It is a logistics anomaly specific to this pivot moment, not a signal of underlying demand erosion. The proof is right there in the same data set. Despite that headwind, the company still posted 59% year-over-year revenue growth and maintained full GAAP profitability. The growth engine is not sputtering. It is running clean at high speed. As the branded distribution ramp fully settles, that timing friction resolves itself completely. Would it surprise you if the next quarterly print came in materially hotter than consensus? Because the demand pipeline has not shrunk, it has expanded in 3 directions simultaneously. Let's talk about the mechanical trap that was set for short sellers, because this rally had a structural amplifier that most people completely missed. Hims carries a short interest of 34.41% of the float, representing over 71 million shares sold short. That is an enormous amount of potential fuel sitting under this stock. When the regulatory news landed, options flow shifted aggressively, with the put-to-call ratio dropping all the way to 0.28, signaling extreme call dominance in the market. But here is the specific wall that matters most heading into next week. There are 21,380 call contracts sitting at exactly the $30 strike. As the stock price approaches that level, Market makers who sold those calls are mechanically required to purchase shares to hedge their delta exposure. That buying creates incremental upward price pressure, which pushes the stock closer to $30, which forces additional hedging, which creates more buying, a self-reinforcing feedback loop with no natural ceiling until those contracts expire or close out. This is not retail sentiment driving this. This is mathematics, and it is still fully live heading into next week. The institutional picture reinforces the same directional story from a completely different angle. Bank of America recently raised their price target from $21 to $25. Barclays is sitting at $29. Needham has a $30 buy rating on the name. Backing all of those upgrades is an 83.21% institutional ownership base, anchored by major positions from Vanguard and BlackRock. At the same time, retail conviction has surged on StockTwits to extremely bullish levels, following a 628% spike in message volume. When large institutions and retail investors are both pointing their conviction in the same direction simultaneously, the resulting momentum tends to consistently surprise on the upside. On the technical side, April 14th gave us a textbook confirmation when HIMSS closed above both its 20-day and 50-day moving averages in a single session. The MACD is showing powerful upward momentum. The ADX, which quantifies trend strength rather than direction, is running at 52.36, an exceptionally elevated reading that tells you this is a genuine trend, not a random fluctuation. The only yellow flag remains the RSI at 75, which puts us in technically overbought territory. Given this is a high beta stock, beta sitting at 2.32, some short-term turbulence is not just possible, it should be expected and welcomed. That volatility is your opportunity to build a position at a reasonable entry. The optimal zone heading into next week is between $25.50 and $26.30. Former resistance that should now function as support on any controlled pullback. Your primary structural floor is $24 even. Secondary Fibonacci support sits at $22.63 if things get choppy. On the upside, the level that matters most is last week's high of $29.78. Clearing that with conviction opens the door to the big scenario. Here is the big payoff. If HIMSS achieves a sustained high-volume break above $30 psychological resistance, the mechanical dynamics we just described go fully kinetic. You bypass the current call wall entirely, removing the primary structural ceiling from the options positioning. At that point, the technical picture opens toward my intermediate-term fair value of $36.66 based on GF value analysis. That is not a blue sky number. That is where this stock gets priced when the market fully reflects the lifetime value expansion, the branded GLP-1 distribution channel, the unlocked hormone optimization platform, and the coming peptide regulatory optionality all together in the same model. The $30 level is not the ceiling, it is the starting gun for the next leg higher. HIMSS has climbed from niche telehealth app to weight loss distribution giant, and is now building what I would call diversified longevity infrastructure, the rails for the future of metabolic and hormonal health at scale in America. That business deserves a platform multiple, not a prescription app multiple. The ultimate validation of this thesis lands this July. Keep your eyes locked on the FDA meetings regarding Category 2 peptide reclassifications and the official 503A bulks list confirmation. If HIMSS receives full regulatory clarity on those 12 peptides, the strong buy thesis does not just strengthen, it becomes the single most compelling structural growth story in the telehealth space. The combination of lifetime value expansion, short squeeze mechanics, institutional anchoring, and the July catalyst window makes HIMSS one of the most asymmetric setups available in the market right now. Before the final verdict, I have to be completely transparent with you. Nothing on this channel, nothing I say, nothing in this video, nothing in the comments or anywhere else constitutes financial advice, smart stock. Sam is an educational and informational platform. I am not your financial advisor, I do not know your personal financial situation, and I am not a licensed investment professional. Stock prices can and do move sharply against any position, including the ones that look the most obvious. Always conduct your own thorough research, understand exactly what risk you are taking on, and strongly consider speaking with a licensed financial professional before making any investment decision. Past price performance is never a guarantee of future results. Now the final verdict. Your entry zone is $25.50 to $26.30 on a measured pullback. Hold your structural risk at $24. The long-term path toward $36.66 looks clearer and more structurally supported than at any point this year. Here is the question I want you to answer in the comments right now. Do you believe HIMSS breaks and sustains above $30 before the July FDA meetings? Or does near-term volatility knock it back to the $24 floor first? Drop your price target and your reasoning below. I genuinely read every comment and engage with the analysis this community brings. If this breakdown gave you real, actionable value today, please hit that like button. It tells the algorithm this content deserves to reach more investors, and it directly supports the channel. If you haven't subscribed yet, do it right now and turn on notifications so you never miss a setup like this one. And if you want to support Smart Stock Sam at the next level, YouTube's Super Thanks feature is available on this channel. Every contribution from this community helps us keep producing the deep, no-fluff analysis you come here for. Thank you for watching, stay disciplined with your risk management, and I will see you in the next breakdown.